Hello friends, let us discuss UAE corporate tax. I am discussing here, you have a business in UAE, Dubai, so your income going to tax in respect of financial year start from on and after 1st June 23. So right now if your financial year is going to start from the January, so you might be hit from corporate tax. Your mainland income would become the taxable at 9%. So there are so many questions. Is it corporate tax? Yes, you are doing business by your own through your natural person. Yes, you are natural person, so your income still be regarded as tax, liable to tax. So only business income is covered. There is not covered salaried income or some passive income, interest, royalty or some dividend income, that is not covered. So your 9% tax is in respect of corporate business income. So in respect of transaction with the related party having presence in free zone would cover transfer pricing provision also. We will discuss in first previously video I have discussed in detailed manner. Right now I am just discussing this provision in summary way with the limelight of international taxation point of view. So let us discuss in summary way UAE corporate tax. So there is a minimum tax free limit is 3,75,000 AED, there is a no corporate tax. Beyond that there is a 9%. So your corporate tax liability, you will eligible for foreign tax credit, net of foreign tax credit you have to pay corporate tax. UAE also covered just recently in the previous month October, they have going to implement pillar 2 BEPS OECD project is base erosion profit shifting. They have a pillar 1, pillar 2. Pillar 2, they are going to tax worldwide income on the jurisdictional basis by 15%. There is a minimum domestic top-up tax is 15%. So right now they have a corporate tax of 9%, but they also given we will implement from 2025 of 15% global rules. So you are a resident person, your worldwide income would tax in the UAE. You will cover natural person only limited to business income. So UAE resident will covered in respect of residency, and salary income, interest, dividend is not covered. So UAE source income is taxed by the foreign person. They don't have P status, that will there is no withholding tax. So just simple way they are going to adopt this corporate tax, there is a 0% withholding tax. So you have a free zone. What is free zone? So still you can start your business in the free zone. All your qualifying income, the free zone will liable to tax at 0%, right? Most of the free zone is offering so many incentives. You can come live, you can get lifetime visa. They are also providing flexible desk and so many things is there. You will get 1 year license. After that you can renew, and you can take a work visa for your employee. So these kind of benefits are offering by the free zone. IFJA is there, JAFJA is there, Silicon Oasis and Sharjah. So your, as I said, your income in free zone is also taxed at 0%. So free zone at any point of time can elect to tax, right? Suppose you are doing business through free zone, also you have a presence in mainland, right? You have a transaction with the related party as a connected person with mainland and free zone. So in respect of all transaction, that transaction must be regarded as transfer pricing. you must follow arm length principle. So this is right time you must understand what is going to impact after coming corporate tax. Might be possible you are buying goods from the your free zone related party or selling through the free zone related party. So you must have take care of arm length principle. You are selling to the related party in the free zone and also selling to the unrelated party, third party customer. So your price selling to free zone related party should be at the arm of the third party. So this is right time you must take TP impact assessment report from the expert, what is going to impact and what is method you should adopt in respect of transaction with the related party, in respect of payment covered by the connected person. So all related party transaction with the connected person will need to comply with the transfer pricing rules and the arm length principle. So main purpose of the P concept is to determine and when the company has established sufficient presence in the foreign country. Okay. So there are allowability of expenditure. There is a cap on interest payment of EBITDA. So BEPS action plan 4 is there. In respect of you have a debt, you are paying interest payment to your associate enterprises. So there is a cap of 30%. Same the provision in Indian taxation regime. The same thing is they have adopted 30% EBITDA. Suppose you have a 100 CR income and 100 CR is EBITDA is there. So they would not allow more than 30% of 100, that is 30 crore as interest payment. So this provision is there. So related party transaction payment made to free zone person, that is tax 0%. You are making payment to free zone, that would not deductible for CT purpose. So however, a related party will allow to claim the deduction in respect of payment attributed to mainland. So suppose you are making to a free zone Jabja payment, so all payment would not tax in the Jabja. So all related party to free zone would not allow to you. Same thing, 50% expenditure is allowed in respect of non-business purpose of having stake of personal element. You have made some entertainment or some kind of expenditure that is non-business purpose. So only 50% of that amount would allow to you. So this is main story of UAE corporate tax. So now we came to go international taxation. So my friends, international taxation is always important. Since domestic tax is UAE, they are going to charge 9%. If you don't have P status, you would not covered by the domestic tax. Based on Article 7, your income would be taxed in the particular country if you have a P status in that country or not. So what is objective of DTA? There is a tax equality and tax neutrality. So in the tax neutrality, capital export neutrality, capital import neutrality and national neutrality. So these are the concept. I have not relevant part here to discuss more. So in the international taxation, DTA, Double Taxation Avoidance Agreement, is not a separate income international taxation code, not a legal provision of the country covering cross-border tax aspect. So international interpretation of tax law of more than one country. So meaning taxation of cross-border transaction, taxation between two or more person in respect of two or more jurisdiction, transaction involving person in one jurisdiction with the property or income flow in another jurisdiction. So residence based taxation, corporate source based taxation. So these are the more two ways of taxation is residence and source base. Basis for apportionment is person have a tax residence property based on the status of the property where is the property situated is tax as per the article 6. Income flow based on the source of the income. So I would covered OECD model convention, UN model convention. So UN model convention is prepared for source based taxation. So need for common understanding of international taxation. Business expansion due to movement of capital and people. So assertion of taxing right by every country. So what the DTA is doing, your actual part should be taxed in particular jurisdiction. So dual and multiple taxation hamper the cross border activity, investment and transaction. So they would give a relief in respect of double taxation or some multiple taxation. So not only for levy of tax by two or more country, allocation of taxing right to the country of resident and country of source, elimination of double taxation by foreign tax credit, and promotion of economic relation between the country. So these are the feature that is relevant for us in the international taxation. So what is the legislation of the international taxation? So first of all, we have a DTA with the country we have signed, right? And over and above, there is a Vienna Convention on Law of TT. So we can take an interpretation from the Vienna Convention Law of TT. So customary international law and general principle of law. So for the interpretation of particular thing, it is static approach or arbitrary approach, we have to refer all those things. So there is a DTA is not a codified law, it is an agreement between the country, the home country and host country. So domestic tax provision are starting from the point of handle cross-border transaction, both direct and indirect. So as per the India have a Income Tax Act section 90 is agreement with the country. In respect of DTA, they have a more than 100 country double taxation avoidance agreement. They have agreement, central government may enter into agreement with the government of any country or specified territory outside India. In respect of agreement for granting relief in respect of income which is income tax has been paid or chargeable, right, granting relief. You have paid taxes in USA, you might get a foreign tax credit in India. Same thing in UAE. For avoidance of double taxation, suppose one income is already being taxed in particular jurisdiction, you can't tax doubly. For exchange of information, there is a FATCA rules is there. Some information is exchanged between the country to country for recovery of income taxes. So these are the scheme of countries. So there is a tax residency certificate. Section 92 of Indian Income Tax Act says that the provision of this act shall apply to the extent that it is more beneficial to the SSE. So in the DTA does not give a right to tax, but it allow you, if better provision is there in the DTA, you can take a beneficial provision in that respect. So on the basis of TRC certificate, you can approach, touch the DTA. If you don't have TRC certificate, you can't see the DTA for beneficial provision. So this is look like a TRC certificate that is for the financial year for particular period that is mentioned. So double taxation avoidance agreement. What is double taxation? So concept is there, imposition of comparable taxes in two or more states due to source and residence. You have a dividend income in particular country, so source based taxation, but since you are a resident in another country, there is a double taxation in respect of dividend income on the same and different taxpayer. So on the same subject matter for identical matter. So there are two type of double taxation. One is judicial double taxation and economic jurisdictional double taxation. In the jurisdictional, same person is going to tax in two different jurisdictions. This is jurisdictional different taxation. Economic person is two different person. A is taxed on the basis of income, company income. B on the basis of dividend. So in different jurisdiction, that is economic jurisdiction. So I here discuss is judicial double taxation. Suppose Indian company or UAE company is making a royalty payment to US company. So based on source, that is accrue arise in India, Indian company would deduct TDS at 10%. So that income is although taxed in the UAE resident country. So here is double taxation. This is called jurisdictional double taxation because the same person is taxed in respect of same income in two different jurisdictions. So we have to get the benefit, look for benefit, what is the provision in the DTA. US, same person getting a tax in US as well as the India. So economic double taxation, suppose Indian company is making payment in respect of commission 100, but the TP officer is not allow you 100 as arm's length price. They would add as 20 as primary adjustment in respect of commission. So that 20 is your TP adjustment is there. So arm's length price is 80 as per the TP provision. Excess 20 will be disallowed. You will allow 80 in the Indian country, but you have made 100 to INC USA. So 100 is taxed here, but you would allow only 80. So 20 is taxed in both country. So this is two different person. I company, Indian company, and I US company, two different person taxed in US as well as in India for the same income 20. So this is the economic double taxation. So why the DTA? The purpose and objective is DTA is granting relief, avoidance of double taxation, exchange of information. So objective is protect against double taxation, free flow of international trade and capital, transfer of technology, prevent discrimination, legal and fiscal certainty, acceptable basis for sharing tax revenue. So here is meaning international agreement between two and more sovereign nations to avoid double taxation. DTA is an international agreement with your host country and home country, also known as tax treaty, convention, etc. TT mean an international agreement concluded between the state in a written form governed by the international law, whether embodied in a single instrument or in a two or more related instrument, whatever it is designated. Legally binding international agreement, not a taxing right, but it is an agreement how to tax agreement on a how taxes are to be imposed. It is a DTA. So relief is available, that is bilateral relief or unilateral relief. Relief in the nature of foreign tax credit you might get in respect of bilateral relief from double taxation. Relief where India has a tax treaty with other country. Taxpayer has an option to govern by the beneficial provision of the act. Whatever more beneficial you can avail, choose. Unilateral relief where you don't have DTA with that country, but unilaterally this relief is available. Relief where the income has no tax with the other country. Domestic tax beneficial provision is beneficial section 194 LC I have discussed. So type of DTA. So as I said, there is a bilateral limited DTA, multilateral instrument is there, comprehensive DTA. So this is the type of double taxation avoidance agreement. So source of interpretation is there. As I said, Vienna Convention of International Law, that is a public international law. Models, we have OECD model, UN model, US model. So source of interpretation. So protocol is there, exchange and notes and preamble is there. In the treaty, there is a clarifying in nature, can be entered even after the treaty. Binding in nature, as I said, Supreme Court in case of Nestle SA, Supreme Court judgment dated 19 October. Recently, there is a held that charge in tax TT through the most favored nation clause under the protocol is required to be notified as per section 90. TT provision cannot be interpreted like binding law. Prevailing practice is relevant for interpreting the TT. No limit on number of protocol. You can find protocol in the clause by clause in the DTA. So there is a multilateral agreement instrument, advance ruling is there. There is a board of advance ruling is there. Mutual agreed procedure is there. MAP is there. If in case of any conflict dispute, you can adopt MAP, and competent authority of both country will try to conclude your dispute. Judicial precedent is there, so many case law of apex court is there. Commentary by the Klaus and Baker. So this is most famous books. So there is a two model convention, and one is US model convention is also there. OECD model convention entered between the developed nation with the comparable taxation system and objective. OECD follow residence principle, lay emphasis on the right of tax of residents to tax, exclude taxation on service. So service P concept is not there in the OECD, but service concept in UN model, that service P status is that would cover, service P status would cover once your employee is deputed to the P country, they spend more than 183 days in particular 12 months. So you would covered by the service P. So India not a member of OECD, but they are observer. Same thing, UAE is not a member, they are observer. So UN model convention is there, entered between the developing country. So India has a OECD and UN model, both type of thing, mix of model convention. They also emphasize source-based taxation as royalty, fee for technical services, and dividend, interest payment. All are taxed based on the source principle based taxation. Income should be taxed where it is arise, seem to accrue arise in here in section 9. So most of the India tax TT are based on this model convention. So article 15 of base erosion profit shifting, BAPS-1 has introduced MLI. MLI is a multilateral instrument. MLI is a single instrument to modify the existing bilateral tax treaties to implement the certain BAPS measure and synchronized and efficient manner. So MLI, we have a more than 100 DTA. So we have entered, signed one MLI signed by the all those countries, so that particular we have adopted this particular thing, but the other country has not adopted, is passed in a synchronized test. So all the TTs are amended through the one MLI. So play between the TT and domestic tax. As I said, domestic tax is going to levy tax on you, but treaty is allow you beneficial provision. Some relief you can get from the treaty. Suppose, as I discussed, SEP provision is covered by the domestic provision, but you don't have PE status, you can go by the Article 7, your income would not tax. So these kind of judicial imprisonment is there. So these are the concept we have to see while we are going through the international taxation. Who is the home state and host country? So suppose you are doing business through home, your country, your income is going to tax home on low only, not your host country, but based on the source country also is going to charge you. Triangle taxation is there. Triangle taxation I will discuss in next slide. Permanent establishment, I have presence in another country through the PE. PE can be any kind of PE, but if suppose you form a PE in the form of subsidiary, that would not covered as a permanent establishment. LOB clause is there. Recently there is a grandfathering provision in Singapore TT and grandfathering provision in the Mauritius TT is famous one for LOB. They would not allow investment through the after the LOB clause is entered. Your capital gain is going to tax as of now. Beneficial ownership provision is there. Suppose you are a beneficial owner for more than 5% stake in any company, you can take beneficial provision for taxing your dividend. Most favored nation concept is there. As I previously discussed, Nestle case, Supreme Court case law. Most favored nation clause you can take advantage, which is going to already given to the third country. You can borrow the limited scope or narrow rate from third country rate. Foreign tax credit, resident country always allow you foreign tax credit. Double taxation conflict, article of tax treaty, these are not. So what is home state? It is a country of residence and host is country of source. So triangle taxation. So suppose you are in a resident country having P in state P, you are earning from source country. So source country is also going to charge based on source status. P country is also charged, and your income would worldwide income is going to charge in your resident country. So this is the triangle problem is there. DTA is usually concluded for bilateral allocation of the taxing right. Specific problem arise in a situation where more than two jurisdiction. In my example, there is a 3 jurisdiction. So involve potential multiple tax claim on the same income. So no uniform solution caused by the triangle problem is there. DTA not provide solution for triangle situation. It can be happen in case of dual residency state. Your income is charged in the source state as well as your residency state. So this will be triangle situation also there. There is a concept of permanent establishment. Entity engage in economic activity across the several tax jurisdiction. P test determine the right of source state to the tax business profit. Define concept under the tax treaty. Suppose you are a resident state enterprises having a earning from another source state, business income or some passive income. So here article 5 is defined what is permanent establishment. Basic rule is fixed place P, you have some place at disposal of you, so disposal test need to be followed. So that place become fixed place P. Service P, as service P is concept in UN model. If you have a devoted 183 days or more in particular 12-month period, that would become the service P. So installation P is there. Suppose you are engaged in the construction services and you have spent more than 6 months, and some TT says 9-month period. So once that period is triggered, you become the construction P. Agency P is there. Once you are giving services through the independent agent, that would not cover. But suppose you are giving services through the dependent agent, so that would covered as agency P. Subsidiary is not a permanent establishment. So basic rule for fixed place P given in Article 5. They have also given in 5.2 what is illustrative list of P for fixed place P. 5.3 discussing construction P, installation fee. 5.4 is exclusion from the fixed place P, some preparatory and auxiliary nature services that is excluded from the P concept. 5.5, 5.6 is covered agency P for dependent personal agent or independent personal agent. 5.7 is in respect of subsidiary associated enterprises, that is not covered in the permanent establishment. So I am discussing the concept of international taxation that would give you some line limit of international T. So as I discuss LOB, Singapore and Mauritius, Article 24 is given Article 24A is LOB clause. So grandfathering provision is not applicable to you, or and a resident of contracting state deemed to be a shell company or conduit company if your expenditure is less than 2 lakh Singapore dollar or 50 lakh INR. So in that case your company would become the conduit company. So these we will find LOB clause. LOB clause can be in the nature of poem. You are doing some transaction with the country and some decision making power or some through another country. So it might become your poem is there, foreign company having a place of effective management in India. So you would be treated as resident in India. So beneficial provision is there. Suppose you have a more than 5% stake in particular country, you can get a beneficial tax rate. So subject to tax, liable to tax. So beneficial provision is in respect of interest income, dividend income. We have to see is there any beneficial provision is there. So some country has a beneficial provision, then we can enjoy the low tax rate. So most favored nation concept. This MFN clause is concept derived from an international trade agreement signifying the universal and equal treatment, benefit in respect of rate, scope, deduction permissible under the tax treaty is signifying extending the beneficial tax treatment agreed with the country to another country. Part of the protocol, typically treaty with the OECD member contain MFN clause. Generally cover income in the nature of interest, royalty, fee for technical services. So this is a contention issue is there. The Supreme Court in case of Nestle, beneficial provision cannot be automatically imported into another treaty, require notification by the government. So treaty provision cannot be interpreted like the binding law. Prevailing practice is relevant for interpreting the law as per the Vienna Convention. A country is required to be member of OECD at the timing of signing the treaty for another country to import the beneficial law. Suppose you are saying basically what the MFN clause is there. I am dealing with this country. My tax rate is 10%. But suppose another country who is also most favored nation country, you have given 5% rate or some narrow the scope. So I can borrow those definitions from the another third country status. So Supreme Court in Nestle case has decided third country must be OECD at the signing of contract. Third country must be the OECD member. Sorry. So beneficial provision cannot be automatically imported, must be routed through the notification by the central government. So foreign tax credit, exemption method, credit method, one income is exempt, resident country does not tax income taxable in the source state, full exemption or exemption with progression. For rate tax purpose they are considered only income, not very common in India TT, right. Credit method, that is relevant in the Indian test. Residence country grant credit of tax in source country, full credit or ordinary credit followed most of the Indian concept. So this is a bilateral or unilateral tax relief. So taxation conflict is there, source residence conflict, source conflict, assessee characteristics nature, income characteristics nature, these are dispute arise. So friends, I have covered all of the international taxation ice cream to you. So UAE corporate tax I have discussed, these are the basically articles, so we have to see relevant article and interpret it accordingly if we have access to the DT. So hope so you have taken much knowledge from my video, and anything doubt for you, you can come to me. Thank you.